Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about California Resources Corporation Annual Report. California Resources Corporation offers a diverse range of businesses and services that cater to the energy needs of various industries. At its core, the company operates in two primary segments: oil and natural gas and carbon management. In the oil and natural gas segment, the company explores, develops, and produces crude oil, oil condensate, natural gas liquids, and natural gas for refineries, marketers, and other purchasers. This includes providing these energy resources to California refineries and marketers. The company's carbon management segment is focused on reducing carbon emissions through innovative solutions. One such solution is the Carbon TerraVault program, which involves building, installing, operating, and maintaining CO2 capture equipment, transportation assets, and storage facilities. This initiative helps companies reduce their carbon footprint while also generating revenue for California Resources Corporation. In addition to its core businesses, the company owns and operates power generation facilities, including smaller gas-fired power plants that generate electricity for oil and natural gas operations. These power plants provide a reliable source of energy for the company's own needs, reducing reliance on external sources. Overall, California Resources Corporation provides a comprehensive suite of services that cater to the energy needs of various industries, from exploration and production to carbon management and power generation. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what could cause a stock price to increase significantly in the past year. The stock price of California Resources Corp has increased significantly in the past year due to several factors that have contributed to its growth and success. One major reason is the company's ability to adapt to changing market conditions and regulatory requirements. By implementing cost-saving measures and investing in new technologies, California Resources Corp has been able to reduce its operating costs and improve its efficiency. Another factor contributing to the stock price increase is the company's strong financial performance. With a significant reduction in debt and an improvement in cash flow, California Resources Corp has demonstrated its ability to manage its finances effectively. This stability and growth have made the company more attractive to investors, leading to an increase in demand for its shares. Additionally, the company's focus on sustainability and environmental responsibility has also contributed to its success. By investing in renewable energy sources and reducing its carbon footprint, California Resources Corp has been able to appeal to environmentally conscious investors who are looking for companies that share their values. This shift towards a more sustainable business model has not only improved the company's reputation, but also provided a competitive advantage in the market. Overall, the combination of cost-saving measures, strong financial performance, and a focus on sustainability have all contributed to the significant increase in California Resources Corp's stock price over the past year. California Resources Corporation market capitalization of $6 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that California Resources Corporation holds a significant advantage in their industry. California Resources Corporation trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.5 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.61%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On one hand, revenue growth is driven by positive commodity price environments, operating cost efficiencies, better than expected well performance, extensions and discoveries, and strategic acquisitions and divestitures. These factors contribute to increased revenue and improved profitability. On the other hand, revenue decline is primarily caused by negative commodity price environments, operating cost inefficiencies, underperformed wells, and incremental waterflood response. These factors lead to reduced revenue and decreased profitability. Additionally, segment-specific drivers such as changes in energy operating costs and non-energy operating costs can also impact revenue growth or decline. In conclusion, the primary drivers of revenue growth or decline are largely influenced by external market conditions, operational efficiencies, and strategic business decisions. Understanding these drivers is crucial for companies to make informed decisions and navigate the complexities of the industry. The net income of the company experienced a decline between 2023 and 2025. In 2024, it decreased by $201 million compared to 2023, followed by another decrease of $13 million in 2025. However, when comparing 2024 and 2025 directly, the net income dropped significantly by $326 million. The profit margins also underwent a change during this period. The operating profit margin decreased from 24.1% in 2024 to 19.6% in 2025. Furthermore, the oil and natural gas segment's profit margin declined substantially from 92.2% in 2024 to 33.3% in 2025. The reasons behind these changes are largely attributed to sustained periods of lower commodity prices, reduced cash flows, and limited ability to fund capital expenditures. Additionally, volatility in oil and gas prices poses a significant risk factor for the company's financial condition and operations. Other expenses such as transaction and integration costs also contributed to the decline in net income and profit margins. The company's operating cash flow is a mixed bag, with both positive and negative indicators. On one hand, several pages suggest that the company is generating significant positive operating cash flow, including $865 million in 2025, as mentioned on pages 7, 101, and 177. This implies a strong financial position and ability to generate cash from its core operations. However, other pages indicate negative operating cash flow. For instance, page 86 shows that the company's net cash used in investing activities exceeds its net cash provided by financing activities, suggesting a drain on its resources. Additionally, page 117 implies a negative operating cash flow based on net income and operating revenue. The mixed signals make it challenging to determine the company's overall operating cash flow position with certainty. Nevertheless, the positive indicators suggest that the company is capable of generating significant cash from its operations in certain years. The company's debt level has experienced a notable increase over the past year. According to the financial reports, long-term debt rose from $1.132 billion in 2024 to $1.283 billion in 2025, representing an increase of approximately $151 million. This significant jump is also reflected in the total debt level, which increased from $1.158 billion to $1.337 billion. In terms of interest expenses, there has been a moderate rise. The company's net interest and debt expense increased by $19 million, from $87 million in 2024 to $106 million in 2025. This increase is attributed to the addition of new senior notes with higher interest rates, which may lead to further increases in interest expenses going forward. Overall, while there are some discrepancies in the financial reports, it appears that both debt level and interest expenses have experienced significant changes over the past year. The company's financial performance has shown mixed results across various segments and regions. On the positive side, the oil segment experienced a significant increase of $696 million due to changes in realized prices and production. Additionally, electricity revenue saw an increase of $74 million. However, other areas have not been as fortunate. The net gain from commodity derivatives decreased by $25 million, although it still contributed positively overall. Furthermore, other revenue declined by $4 million. These declines indicate that the company faces challenges in certain segments and regions, which need to be addressed for improved performance. The management of the company is optimistic about its future prospects, driven by a clear strategy that prioritizes decarbonization through carbon capture and storage (CCS) projects. The company has made significant acquisitions in recent years, including the Berry merger and Era merger, which have positioned it for growth in key areas such as oil and natural gas production. Management is also focused on cost efficiency, with efforts to reduce operating costs and improve productivity. This is reflected in the expected decrease in healthcare cost trend rates for union employees from 8% in 2026 to 4% by 2034. The company's financial projections are strong, with a standardized measure of discounted future net cash flows increasing to $6.7 billion as of December 31, 2024. In terms of investment and capital allocation, management is committed to strategic investments in CCS projects and partnerships with companies like Brookfield. This is part of a broader effort to reduce the company's carbon footprint while driving growth and profitability. The company has also increased its share repurchase program by $430 million and extended it through December 31, 2027, demonstrating its commitment to returning value to shareholders. Overall, the company's outlook and strategy are centered on decarbonization, cost efficiency, and strategic investments in key areas. Management is confident that these efforts will drive long-term growth and profitability, while also contributing to a more sustainable future for the company and its stakeholders. The company has made several significant transactions through its acquisitions and divestitures. On the acquisition side, the most notable deals include the Era merger in 2024, which was a major milestone for the company, followed by the Berry merger in 2025. Additionally, the company formed a joint venture called Carbon TerraVault JV, although details about this transaction are limited. The company has also made several divestitures, including the sale of oil and gas assets located in Ventura in 2025, resulting in a loss of $1 million. In contrast, the divestiture of non-core assets and Ventura properties in 2024 generated a gain of $11 million. Furthermore, the company redeemed its 2026 senior notes in full in 2025 and repaid Berry's long-term debt as part of the 2034 senior notes offering. The company has also made several other divestitures, including the sale of Fort Apache real estate property for $2 million in 2024. Additionally, the company made settlement payments totaling $122 million in 2025, which included $35 million from Era settlement payments. The company has also decommissioned 2 offshore platforms through Signal Hill Services, Inc., and sold 120 orphaned oil and gas wells located in Cat Canyon to current operators. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which are payments made by the company to its shareholders out of its profits. The company has paid dividends on multiple occasions, as indicated in several pages of the report. In addition to paying dividends, the company has also bought back shares from the market. This means that instead of distributing cash to shareholders through dividends, the company has used its funds to purchase a portion of its own outstanding shares. By doing so, it has reduced the number of shares in circulation and increased the value of each remaining share for existing shareholders. There are concerns about inventory buildup and potential supply chain disruptions. The company's financial statements reveal a significant impairment of excess and obsolete materials and supplies, totaling $13 million. This suggests that the company has accumulated too much inventory, which can be costly to maintain and may not be easily sold or utilized. Furthermore, the inventories have been valued at $6 million, indicating a buildup of unsold goods. The impairment of materials and supplies inventory by $13 million in 2024 is another indication of this issue. Additionally, there are concerns about the long-term impact of the current tariff regime on supply chains, which could lead to disruptions if it persists or expands. This could have far-reaching consequences for the company's operations and profitability. That concludes the financial summary for California Resources Corporation. Feel free to comment below, and I will be happy to answer them when possible.